Welcome back, Alpha Hunters. This video will be about the basics of options and much of the terminology, but no calculations or trading examples will be done in this video. See you on the green side. So you want to learn about stock options. You are in for quite the learning curve as you start learning about options. The analogy I use is stocks are like checkers and options are like chess. And how many of us are masters at chess? Stocks are pretty straightforward and easier to pick up, much like checkers. But options have different pieces moving in different ways, like pieces on a chessboard. I'm not trying to scare you, but I want you to know that it takes time to learn options, as there are many concepts that are new here that are not seen in other investment products. Take your time, rewatch if necessary, practice paper trading, but don't rush into using options with real money, as you can lose all your money and quickly. But options, if used correctly, are an integral part to an effective portfolio. Let's begin with what stock options are. Stock options are contractual agreements between the owner of the contract and the writer of the contract to transact a specific number of shares at a specific price by a specific date. If you're thinking, I thought stock options were only for higher levels of management, CEOs, or board members. Well, you're not wrong. Those are non-tradable stock options, a part of a compensation package for those positions. They are meant to be a bonus reward structure for increasing the company's stock value over a period of time. The options contracts written in those compensation packages are customized, which is why they're labeled non-tradable. Those stock options we don't have access to, but we do have access to standardized stock options, which are uniformed for public trading. From now on, I will just be using options for short. Options are contracts that give the purchaser the right to do something with the underlying stock by the expiration date. The seller, aka the writer of the option, is obligated to fulfill the terms of the contract if necessary. Options primarily started out as insurance for stock positions, much like buying a homeowner's insurance or car insurance. With the rise of the internet, options have become more accessible and therefore more tradable, especially among retail investors. Now there are two types of options contracts: calls and puts. Call options will allow the buyer of the option the right to call away shares from the seller as long as the stock is above an agreed upon price. Think back to the CEO that got an options contract in his compensation package. If the stock goes higher, he would then be able to buy shares at a discount to what the market is currently trading at. This is the basic idea of a call option. As the stock went higher, the CEO's options were worth more. Put options will allow the buyer of the option the right to put shares to the seller as long as the stock is below an agreed upon price. What about the house with the homeowner's insurance? Well, if a tree falls on the roof and wall causing damage, it will lower the value of the home. Use your insurance to fix the home and restore the value of the home. This is the basic idea of a put option. As the house dropped in value from the damage sustained, the insurance contract became more valuable. So far, I hope you're not lost like this guy.
Who's Fabio?
He's a shortstop. He's a shortstop from Seattle.
Now let's look at the different parts of options. Let's start with the four components needed to identify an options contract. First one is stock. In that CEO example, the stock in the contract for the compensation package would have been the stock of the company. But for us non-CEO types, we need to find a stock with options listed. Not all stocks have options, but many do, especially big companies you've heard of. Another component is the expiration date. This denotes the final day the options will be valid and active for trading. And it's much like your insurance policy, which has an end date. There are typically several expiration dates active at any given time, with Friday being the standard day of the week the expiration dates fall on. This is the one component that sets options apart from stock. Next is the strike price, or as I was mentioning earlier, the agreed upon price, or the deductible limit. Much like when you have insurance, you can't use your insurance until you go over your deductible. So picking the right strike price, like your deductible price, is very important so this can protect your assets from big losses. The strike prices you will see in the options chain have standardized point increments, typically of 2.5 points, 5 points, and 10 points. Last component to identify an options contract is whether it is a call or a put option. This lets the seller and buyer of these contracts know which direction the shares are going between the parties if necessary. If you as the buyer has an insurance policy with a deductible of $1,000, then everything above that, you just send those bills to your insurance as they are the seller. These 4 components are needed to identify an option. To be able to value an option, we need one more major component: volatility.
Tequila.
Now, there are 2 types of volatility that impact the pricing of options: historical volatility and implied volatility. Historical volatility is calculated based on the previous price action of the stock. So if the stock starts to have wilder price swings, the historical volatility will increase. Think of historical volatility as the baseline for volatility. Implied volatility is a theoretical calculation and has more to do with forward-looking expectations, such as upcoming earnings, expected product reveals, governmental announcements, pharmaceutical approvals, etc. Implied volatility is the extra adjustment to volatility that historical volatility cannot account for. So as we stand here right now and then turn to look backwards in time, we would be looking at historical volatility. If we look forward in time, we would be looking at implied volatility. What is standardized about options contracts for us to be able to trade them? Well, several of them we've already talked about. The asset, which would be, in our case, the stock. The length of time the contract would be valid, which would be the expiration date. The agreed upon price, or the deductible, would be the strike price. Whether or not it's a call or a put. And lastly, each contract represents 100 shares. Now, this is important as we get to options pricing and entering orders, because options price on a per share basis, not a per contract basis. The last thing about basic options is understanding how they change in value, which comes down to several components called the Greeks.
This is Sparta!
No, we are not talking about Leonidas and his 300. Xerxes for the win. Instead, we are talking about components that got their name from Greek letters: delta, gamma, rho, theta, and vega. Delta tracks the change in options price for a 1 point change in stock price. Gamma is the rate of change in delta for 1 point move in the stock price. Delta and gamma go hand in hand, but think of delta as velocity and gamma as acceleration. Rho is the value change for a 1% change in interest rates. Rho also isn't covered that much and probably won't be covered much on this channel for the simple fact that interest rates don't change as often as the other components. Theta is the value that is lost from the passage of time, typically 1 day. This is also known as time decay. And anything that gets its own nickname, you know it's important. So we'll be covering a lot of theta. Vega is the change in option pricing for changes in the stock volatility. This is where you need to spend much of your time learning about options. And I will provide separate detailed videos about these so-called Greeks. If you are seeing this and you haven't traded stocks before, or you just need to step back, click on the video in the top left for a look at trading stocks. Alrighty, take care, Alpha Hunters.